Well, Mahesh Patil joins us, and let's connect with him to understand his market view. Where are they picking their spots, and what is the reason why we've seen such a strong comeback in global markets from that panic low of 2nd of August? So, Mahesh, good morning. Thank you for joining us.
Yeah, good morning, Dinesh.
Mahesh, exactly 2 weeks ago, this market was in a panic zone. Everything was just going down the spiral, so to speak. But from there, equities, bonds, currency, even gold has made a roaring comeback. So why do you think market, despite all the macro concerns, have made such a roaring comeback?
Yeah, so it's again pretty interesting and also slightly confusing also in terms of the market reaction what we have seen. I think one thing I think is clear that it started off with concerns that U.S. recession again became the center point, right? But I think as things have progressed, we've seen that the chances of a U.S. recession have further come down, right? It had gone up a bit, but again it's come down. So I think that probably is giving a hope that in the US, which is actually at the center point, right, where probably will still be a soft landing, and that continues. Also, in terms of the US election outcomes, there were some expectation. I mean, earlier it was Donald Trump, which was leading, and that meant that you might see some kind of volatility because he is known to take a very kind of a hard stance. But that is also kind of now it's a neck to neck fight over there. And I think overall, I would say the liquidity and this thing, especially in India, if you look at it, right, the liquidity flows continue to remain fairly strong. I mean, domestic flows, what we saw, right, in the last month, again, were at record levels. So while there has been FIS selling, which has been there, and that's been, again, a global sell-off, which has been there, it has been easily absorbed from the domestic flow. So I think I would say more liquidity and some easing of concern on US recession, I think probably the reasons why the markets have kind of looked up from those levels.
What should be a basic strategy right now? Because if I look at valuations and the combination of earnings, there's hardly any value left in the market. So do you think it's time to perhaps take some cash off the table, book some profits, even if you're an SIP investor, perhaps it's time to perhaps book 5, 10, 15% gains?
Yeah, so I think for a long-term investor, I think if you look at it, still makes sense to continue with the SIP because, as I said, the overall domestic outlook. If you look at even this quarter numbers which have come in, while overall growth has slowed down in the top line, but by and large, bulk of the sectors, the results were more or less in line. We haven't seen any major downgrades to earnings over here. Earnings we think will compound at around 12-13% over the next few years. So I think that should give a healthy upmove in the market over a longer term period. And again, if you look at the larger Nifty per se, right, while the broader breadth of the market has been very, very strong, Nifty is, if you look at valuation wise, it is only a tad expensive than the long term average. So I think given that, I would say continue with the SIP. Obviously, it's since there is a kind of a dichotomy in the market. We have seen small caps, mid caps, where the valuations have gone up. Clearly, I think it's time to reduce the risk in the portfolio. So I think that's the kind of an adjustment, which one needs to do. Even for investor trying to move in from while staying put into equities, moving from a high risk funds or high risk asset class to a slightly more moderate risk, I think would be more advisable over there. And even as an asset allocation, if somebody is really following an asset allocation kind of a theme, then in that sense, I think it would make sense to probably take some gains out of equity and then balance it out. Whatever gains one has gained in the last 1 year, I think that can be redistributed back to say fixed income or gold for that matter. Because in fixed income also we are seeing a reasonably good carry at this point in time. Which would on a risk adjusted basis that also looks to be a decent kind of a return over there.
Mahesh, RBI time and again is coming out and saying that there is rural demand coming back and there's a recovery at play. Just as early as yesterday's report also talks about that. Which are the categories on the rural side which you will be most comfortable and you've been nibbling in the last few weeks and months where valuations are comfortable?
So rural, yeah, I mean, that's been an expectation that this year at least rural should come back. And monsoons have been fairly good. I mean, initially they were a bit late, but I think they have caught up. So I think that should not be such a concern. Rural, again, wages also, right? The real wage growth, which was negative, is now turned slightly positive because inflation has come down. So I think all these bodes well for pickup in the rural economy, though it's still very, very slow and gradual, I would say. I mean, if you look at really to play the rural, it's basically consumption is what you're looking at, right? And broader consumption, which has been kind of lagging behind. I mean, that has lagged the recovery since COVID. I think we should see some catch up, and really to play that, one can look at the consumer staple names, consumer discretionary also. I think consumer durables, even the auto names, for example, right? Where autos is still weak. I mean, two wheelers. Last year we had a reasonably good growth from the bottoms over there, but still it is lower than the almost near to the earlier pre-COVID peak. So there is some amount of room there if rural economy really picks up over there. So I would say consumer staple, consumer discretionary, consumer durables, auto sector are could be the sectors, okay, which one can look at really to play the whole consumption theme.
Mahesh, so where are you picking your spots in this market? Defense, railways, banks, where are you picking your spots in the PSU space?
So specifically on the PSU side, if you look at it, there I would say the power sector, for example, the utilities, okay, where I mean, especially in the power side, power generation and power transmission and distribution side, there has been clearly an uptick in terms of revision in the targets, right? What has been said earlier. So that clearly opens up a better growth opportunity in that sector over the next 5-year time frame. And while the valuations are on the higher side, but in compared to the historical average, even absolute term, they are still reasonably okay to really look at that sector. Also in the power sector, the energy space, right? The oil and gas sector has performed well, but not really done as well because especially the OMCs, where last quarter was kind of weaker because of the lower refining margins. But I think where the oil is now positioned and with oil prices remaining lower, I think you should see a good on the companies making good on the marketing margins. So I think the oil and gas space in that space is also looking fairly reasonably priced at this point in time. So I think these are the sectors. I think in the defense and this thing, while the outlook there continues to remain fairly strong over there, I think one would wait for some kind of a moderation because we've seen some execution slackness in the last quarter, and that could, if there's any correction, I think then it could be a good entry point to look at some of these names on the defense side.
Mahesh, we are getting mixed signals. Ajay asked you about rural economy, but I have data from the auto sector which talks about discounts have come back, waiting period is over. I look at toothpaste sales, they are going up. I look at hair oil sales, they are going up. I look at two-wheeler sales, they are going up. But when it comes to autos, SUVs, luxury cars, they are slowing down. Retail, real estate also, the data seems to be very similar. So why are we seeing such a reversal? Rural is suddenly back up and urban and semi-urban is taking a backseat.
Yeah, I think so. I think we saw rural. I mean, the urban recovered. I mean, last year the recovery in the urban was much stronger, especially in the upper segment of the urban population. So the demand for higher end goods, right, and the premium products was fairly strong. I think there is some amount of kind of a fatigue or saturation probably creeping in over there. I think the initial buoyancy what we saw last year. Okay, I think to that I think there is some kind of a normalization over here. On the other hand, on the rural, the bottom of the pyramid, okay, which was really weak for the last 1.5 years, I think that is seeing some green shoots because there the base is also kind of favorable if you look at for the last 2 years. So I think it is more about some kind of a mean reversion of that, okay, where the urban and the upper end of the segment, which was doing very well, is kind of normalizing, and the bottom end, which is kind of weak, is again trending back towards the mean. I think it's more of a normalization trade, is what I would see.
Right. Okay, that's the take coming in a bunch of those sectors. But Mahesh, just wanted to understand, what is your biggest sectoral overweight and underweight right now?
So at this point in time, I mean, our larger overweights, for example, would be in I mean, in the auto ancillary sector, the consumer discretionary, consumer durable sector, where we are seeing signs of improvement in the last quarter over there. In the overall capital goods and industrial space, where again we think that the whole capex recovery, what we are seeing is we are still in the early stage of the cycle. So there is a long runway over there for growth, while the valuations there are on the higher side. We're also positive on the telecom sector, because again it's somewhat of a defensive at this point in time, where steady growth, deleveraging cycle playing out, some tariff increases down the line. Pharma is another sector where we are overweight, not only domestic pharma but also the US generics market is seeing actually some kind of a tailwind in terms of margin expansion, because the pricing pressures which were there seems to have eased off, at least for some time. And overall, the healthcare sector, also the hospitals and other sectors, again is a good defensive, which we think where the pricing is good. The move from the consolidation which is happening in that sector will drive better growth over there. So I would say these are some of the sectors, okay, where we see a reasonably good growth visibility in the coming years.
Okay, Mahesh, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
Thank you.
If you like this video, then like, share and subscribe to ET Now.